Hi there, tax accountants. I hope all is well. And I pray that as you're viewing this video, that you are in the best of health and spirit. This video will cover chapter 3, business income and expenses. So essentially, this chapter covers Schedule C, profit or loss for business, sole proprietorship, and many of the common business expenses that are allowed as deductions in determining taxable business income. So we start off with this first problem, and it asks us to complete Schedule C for Shelley, showing her net income from self-employment. Make realistic assumptions about any missing data. It says, Shelley Wee is self-employed as a professional golf instructor. She uses the cash method of accounting, and her social security number is 466478833. Her principal business code is 812990. Shelley's business is located at 96-540 Ala Ike, Pearl City, Hawaii, zip code 96782. And it says during 2023, Shelley had the following income and expenses. Fees from golf lessons of $47,000, expenses. So we see there's various expenses here: car expenses, business liability, office, rent on office space, license, travel expenses, meals, utilities, and membership in a professional golfers association. So, as we mentioned, this chapter covers Schedule C. So essentially, a taxpayer who operates a trade or business, or they practice a profession as a sole proprietorship, or a single member LLC that has not made the election to be taxed as an S corporation or a C corporation, they are going to be required to file what's called Schedule C. So here below, we have an example of what Schedule C looks like. Again, this is Schedule C. It is associated with Form 1040. This is a federal form. As you see here, Department of the Treasury, Internal Revenue Service. This is the title of the form: profit or loss for businesses, sole proprietorships, and again, single member LLCs that have not made a check the box election. They are also required to file this form. And then you see here, it says attached to Form 1040 or 1040 Senior, 1040 SS, and R 1041. Partnerships. This is where there's more than one individual who operates a business. They do not file a Schedule C. Instead, they file Form 1065. And as you're going through the forms, any form for that matter, you can always look at the instructions. So let's say there's a line item and you're not 100% sure how to complete it. You go to the instructions. Every form has a set of instructions to help you interpret what belongs on that line. So just keep that in mind. All right. Then you have the name of the proprietor, their social security number, the principal business or profession, including the product or service. You input the business name if there's a business name. If there's no separate business name and the individual is operating just under their name, you leave it blank. The employer ID number, the EIN number, that's essentially the equivalent to individuals. We have a social security number. Businesses, they can apply for an EIN number, which is the same thing. It's an identifying number for a business, and it can be filed for free, or you can apply for one for free, rather, through the IRS. Then we have the business address. Then we have the accounting method. It can be cash, it can be accrual, and if it is other, maybe it's a hybrid of cash and accrual, then you need to specify. G asks, did you materially participate in the operation of this business during 2023? If the answer is no, then this might potentially be considered a hobby and not a business. H, if you started or acquired this business during 2023, you would check here. I, did you make any payments in 2023 that will require you to file Forms 1099? So essentially, anytime you pay an individual, or depending on the type of business, $600 or more, to claim the deduction, you're required to file Form 1099 miscellaneous or 1099 NEC, depending on the nature of the payment. J states if your answer to I is yes, then it's asking, did you file the required forms 1099? And if you didn't, then there's a penalty. So you definitely want to ask clients those questions. So here we see on this schedule C, before we go through the question, I just want you guys to, get a better understanding of the purpose of this form. So this form has several parts. The first part is part 1. Income. So this contains the calculation of the taxpayer's gross income from the business or profession. So we have gross receipts or sales. And then we do have certain instances where there are persons who receive Form W-2 and they are treated as statutory employees. So even though they are employees, they get to write off certain expenses, right? It's not uncommon, it happens. Returns and allowances. So this would be for businesses that sells products. Obviously, if a business has services, you might or might not see this. Cost of goods sold, which we'll learn a bit about a little later. So that's basically a company that sells products. Again, inventory represents items that the company has that they plan to resell versus supplies that they're using in the everyday course of operation. So an example would be, let's say someone has water bottles and they plan to resell the water bottles, that's inventory, versus a person having water bottles in the office for staff to drink. All right. So it's very important to differentiate between the two. From there, you get gross profit. And 6 designates any other income that might have been received. 7, you get your gross income. And then in part 2, it basically lists all of the expenses. So, they have line items from 8 through 26. And let's say there's an expense that does not have a specific line item, then 27A, you can basically list all of the other expenses in part V that do not have a corresponding line, 8 through 26. In 28, we get our total expenses. 29 represents our tentative profit or loss. If there's a home office, from there in line 30, we would essentially calculate the applicable or deductible rather amount of home office expenses. And from there, you get your net income or net loss. And this amount will be transferred to the face of Form 1040. Part 3, this represents cost of goods sold. So as mentioned, this is essentially factored based on the beginning inventory plus any purchases. And then from there, you would consider any cost of labor, cost of supplies and things of that name. We would factor in the inventory at the end of the year. And when we subtract these amounts, that lets us know the cost of goods sold, which basically represents the total cost of the items that we sold pretty much. So the meaning of cost of goods sold is in the wording in and of itself. Next, we have part 4. So part 4, this is essentially if a taxpayer uses a car or a truck in their business, then this needs to be completed, right? So it basically includes, when did you place your vehicle in service for business purposes? This is important because sometimes clients, they have a vehicle and they use it for both personal and business. So we need to be able to differentiate what's the total business mileage, what's the commuting mileage, any personal. Then you also need to account for these questions. Was the vehicle available for personal use during off-duty hours? If it was also used for personal use, then we can only allocate the business portion. If it's 100% used for business, then everything is basically written off 100%, nothing to worry about, right? It asks, do you have another vehicle available for personal use? Do you have any evidence to support your deduction? So an odometer, there are certain programs whereby you can track your mileage when you, meet with clients or do anything business related. And then lastly, if the evidence is written. And then lastly, we just have part 5, as we mentioned earlier, some other expenses. So we are going to start to work on this problem. Right, so I'm going to make this a little smaller. So that way we can see both at the same time. All right, so here we are. So this problem, again, it wants us to complete or prepare rather the Schedule C for Miss Sally Lee. All right, so the social security number and that information has already been input, so we are good to go from there. But now we're going to start to prepare the form. So gross receipts or sales, it lets us know the total fees from golf lesson represents 47,000. So we input the 47,000. There's no returns or allowances, so that's blank. Line 3 asks us to subtract line 2 from line 1. So 47,000 minus 0 is 47,000. We have no cost of goods sold. This is not a business that sells products. Instead, it provides services. So we have no cost of goods sold. We get our gross profit, which is obviously 47,000 minus 0. And then there's no other income. So we just carry down our total gross income. So normally, let's see. All right, so normally in the profession, whenever you deal with numbers, you want to make sure, that you're not missing anything. So we accounted for the golf lesson, so we crossed that out. Next, we can just start to input all of the numbers that we, need to factor in. So we have car and truck expenses for $3,275. We've accounted for that. We have business liability insurance for $500. We've accounted for that. We have office expense of $600. We've accounted for that. Rent on office space. So we have rent for vehicles, machinery, and equipment, and then we have rent for other business property. So we would input the amount on 20B. Our city business license for $300. Travel expenses of $1,235. Our deductible meals. So keep in mind, meals is essentially limited to 50%. So the deductible portion is $700, which means that in total she spent $1,400 and only 50% is deductible. So in most softwares, you enter the full amount and the program would automatically calculate 50%. And then there's some programs, depending on which tax return you're working on, you have the option to either enter 100% or 50%, the deductible portion, as we are doing here. Next, we have utilities for $515. And then we see there's no space for us to enter membership in professional association, right? There's no line item. So we essentially scroll down and then we go to other expenses and we input membership in professional association. And then from there, we input the $750. And this $750 is going to transfer to line 27A. And then now the next step is for us to determine, well, what are our total expenses? So we get our handy dandy calculator. And we start to add up the amounts. So we have 3,275 plus 500 plus 600 plus 9,800 plus 300 plus 1,235 plus 700 plus 515 plus 750. That gives us total expenses of $17,675. So our tentative profit and loss. Our golf lessons total 47,000. And from there, we subtract our total expenses of $17,675. So our tentative profit, in this case, we don't have a loss, is $29,325. So if we scroll down, it's asking, What is our net profit or loss? We don't have to account for any home office expenses. So therefore, this 29,325 represents our total income. All right, so this one key thing to keep in mind with our car and truck expenses, right? This information would be input here. So that 3,275, this would be input, and then that 3,275 would, transfer there. We obviously just, kind of did the reverse since we were already on the form. So just keep that in mind. So when did you place your vehicle in service for business purposes? If we scroll to the top, it lets us know she bought her car January 1st, 2023. In addition to the business miles listed above, she commuted 1,200 miles and drove 4,500 miles for non-business purposes. So we scroll down. January 1st, 2023, the business miles were 5,000. The commuting miles were 1,200. And the other miles were 4,500. All right. So again, you input this information into the tax software, and then this information will transfer over. All right, so this was, again, just a quick example of how these amounts are calculated. And one key thing that I also want you to keep in mind with the mileage. So this problem made it a little easy for you. It just gave you the total amount of the car expenses. But one key thing to keep in mind is that with the car mileage, she's taking the standard deduction. So the business miles, 5,000, and the IRS allows you to take for 2023, 65.5% or cents rather for each business mile driven. So 5,000 multiplied by 0.655, that is how we calculated the 3,275. So this problem made it a little easy for you. In the next example, we're going to need to actually calculate it ourselves. All right, so just keep that in mind. The business miles multiplied by the standard mileage rate, and this is adjusted each year, for inflation or depending on, what's happening in the world. Tax laws, obviously, they change from time to time. But as of right now, for 2023, it's 65 0.655 cents. All right. So you prepared your first Schedule C. Next, this brings us to a question about determining what we just discussed, standard mileage method or the actual cost method. So when an individual has a car, a vehicle that they utilize for business purposes, certain transportation expenses are deductible by taxpayers. So there's two options. Either they can deduct the actual business related expenses of transaction, or they may be entitled to using the standard mileage rate. So as mentioned, the standard mileage rate is normally adjusted each year, and most costs associated with the automobile. So obviously, if you use the actual cost method, then you're accounting for things like gas, oil, insurance, repairs, any maintenance, including car washes and things of that nature, as well as appreciation. You account for those things under the actual cost method. But under the standard mileage method, this is more so an easier way to account for it, because it's like now you don't need to keep all of your gas receipts, or you don't need to keep all of your mechanic receipts and things of that nature. And again, you can just utilize an odometer or an app that tracks your mileage throughout the year. So in this example, it says Mark Lewsbrink, sole proprietor of Oak Company, bought a used automobile that was driven 13,000 during 2023. All for business purposes. Perfect. We don't need to allocate anything. So total miles, including business miles, is 16,000. So we know the total business miles, and we know the total miles. Since only 13,000 is business mileage, then 3,000, which makes up the other amount to get to 16,000, would be personal or commuting or something like that. So his total expense for his automobile for the year are gasoline, oil changes, insurance, tires, repair, total. It says the automobile cost the 40,000 on January 1st, and total depreciation for the year, including personal use, was 8,000. His business parking and toll fees for business amount to $327. So it wants us to calculate Mark's transportation expense deduction for the year under each method listed below. So as mentioned earlier, the standard mileage rate for 2023 is 65.5 cents per mile, right? So we calculate the standard mileage rate, and then from there, we also need to factor in parking and toll fees. Just keep in mind, parking and toll is not subjected to a limitation. Instead, that calculation for parking and tolls, they can claim 100%. So just keep that in mind. All right, so we're going to open an Excel, and we'll go through the problem here together. All right, so we look at this information, we need to determine, are we going to take the standard mileage rate, or are we going to claim the actual cost deduction? So business miles, which we know were 13,000. I'm actually going to shift this down a little. So 13,000 represents our total mileage. Our standard mileage rate, as we just mentioned, is 0.655, so 65.5 cents. So we add this up, 13,000 multiplied by 65.5 cents, which gives us 8,515. And then the problem lets us know that tolls and fees, so if we go back to the problem, it says his business parking and toll fees for business amount to $327. So 100% of tolls and fees. So if we add it up, the standard mileage, which is 13,000 business miles, multiplied by 65.5 cents plus 100% of tolls and fees, our standard mileage costs, if we choose this method, would be $8,842. Right, in comparison to our actual cost method. So if we factor in our actual cost method, we know how much, our cash outlay was, how much we paid in cash for our expenses. So we see there was a total of $4,028. How do we know that? It's the total of the gasoline, oil change, insurance, tires, repairs, etc. $4,028. From there, we account for our depreciation. How do we know that? It shows us here total depreciation for the year, including the personal use, was 8,000. So the depreciation. So we want to determine the total cost. We sum the two. The cash that we spent plus the 8,000. Total cost of 12,028. And now we need to determine, well, okay, what is our business percentage use? So in order to determine that, we divide our total business miles, which is 13,000 miles, divided by the total miles driven, which is 16,000 miles. So 13,000 divided by 16,000. Let us make that a percentage. All right, so it'll be 81.25%. So we need to determine our subtotal. So the total cash that we spent and the depreciation is 8,000. That gives us a total cost of 12,028. However, for business purposes, we only use the vehicle 81.25%. So therefore, we can only claim the business portion of the cost. So that gives us a subtotal of 9,773. And much like for the standard mileage calculation, tolls and fees, 100% is considered deductible. So we add that 327. So we add our subtotal plus 100% of tolls and fees. Actual costs calculation gives us 10,100. So if we compare the two, generally the taxpayers are, as we mentioned, allowed a deduction based on the use of the automobile, and they take whichever deduction is going to give them the greater, expense. So obviously in this case, $10,100 is going to work better in Mark's case. But one key thing to keep in mind, so if the taxpayer, they're entitled, obviously to use either. They can use standard mileage or they can use actual cost. But one thing is that if the taxpayer doesn't use this standard mileage method in the first year, they cannot use it going forward, right? But a change to the actual cost method can be made in any year. So keep that in mind. Again, I'm going to say it again so you understand. Of course, in this case, the 10,100 is going to work best in their case because we see there's a difference of about, like 1,000 or so. But if they do not use the standard mileage rate in the first year, they cannot use it in the following years, right? But if they use the standard mileage rate first, they can make a change to the actual cost method in the future. So just something to keep in mind. All right, so we'll go back to the problem. Oh, well, the standard mileage method, as we know, 8,842. The actual cost method was 10,100. So which method should Mark use? The actual cost, because it provides a greater deduction. But just keep in mind that rule that if they do not use the standard mileage rate or standard mileage method rather in the first year, they cannot use it in the future. If they use standard mileage rate in the first year, they can switch to actual cost in the future. So just a little caveat. So here it asks, which of the following is not a test for deductibility of a business expense? So generally, a trade or business for tax purposes is basically any activity that a person or persons engage in with the intent of making a profit. So that's the key thing. Trade or business. Is the goal ultimately to make a profit? Keep in mind, you don't necessarily need to make a profit because especially when you're first starting a business, a lot of times you are spending money to invest in the business and you're not necessarily generating a lot of revenue. So the IRS, tax laws are aware of that. But you want to make sure that you are, putting effort, regular, continual effort into this business. So there are some tests that need to be met to qualify certain expenses and things of that nature. Reason being, because let's say I love to crochet and I crochet several pieces, but it's just like a hobby for me, right? I'm not really trying to be a millionaire. I'm not trying to make this, like a side hustle or anything of that nature. So in such case, there are different rules that governs that type of an activity. It would not be considered a trade or business because I'm not engaging in the activity to make a profit, right? So that's very important to keep in mind. So expenses, they have to meet several general tests to qualify as a deduction. So we have what's called the ordinary and necessary test. So this is governed by Section 162 of the Internal Revenue Code. And under this tax law, for trade or business expenses to be deductible, they must be ordinary and necessary. So what that basically means is that this type of expense is commonly found for the specific business and it's helpful, it's necessary to run the business. So let's say I have an accounting firm, right? And I have this accounting firm and I have a expense for a yacht, right? So it's not generally ordinary, right? But it can be justified. This is one thing I want you to keep in mind. It can be justified because let's say I deal with very high net worth clients, right? And I purchased this yacht because maybe I host seminars on the yacht. Maybe I use it to, engage with clients and to discuss business meetings because of course they are high net worth. They are, what's the word I'm looking for? High end, for lack of a better word, right? So in a case like that, I can kind of justify it. But let's say I'm just, running a brick and mortar or maybe running it out of my home office. There's no need for me to have a yacht, right? So in certain cases, you can see, why an expense is ordinary and necessary. But for the most part, the key thing Is this commonly found in a specific business, and is it helpful? Is it appropriate to run the business? In addition, a business purpose test expenses have to be legitimate business purposes to be considered deductible. Sometimes there's a gray area. An individual may, pay for something that benefits them both personally, as well as relates to their business. If so be the case, you can only deduct the business portion. And lastly, the reasonableness test. Tax law requires that deductions be reasonable to be deducted. So this is asking which of the following is not a text. Sales generation is not a test. All right. It says Mary must also file. In the current year, Mary started a profitable housekeeping business as a sole proprietor. She has 10 housekeepers working for her and spends her time selling their services and coordinating her employees' time. Mary made $50,000 in her first year of operations. In addition to filing a Schedule C to report her business earnings, Mary must also file. So, as a self-employed individual, of course, you file Schedule C, as we know, which is the profit or loss from business. And in addition, they also need to file what's called Schedule C. So SE, rather. So A is our correct answer, but we're going to go through all the answer choices because I want you to understand what those forms are. So self-employed, taxpayers, sole proprietors, independent contractors, members of a single member LLC, if they have net earnings of $400 or more, they file the Schedule C. In addition, they also need to pay self-employment tax, and that is calculated on Schedule SE. So if you were an employee for a business, there's what's called Medicare taxes and Social Security taxes. So the employer pays 6.2%, and the employee also pays 6.2%. Medicare taxes are 1.45% for both the employee and the employer. So as a self-employed individual, you are considered both the employee and the employer. So there's an equivalent called FICA taxes. And with these FICA taxes, as we just mentioned, which is Medicare and Social Security taxes, for self-employed individuals, that is basically self-employment taxes, but it's basically the same thing as Medicare and Social Security taxes. So that's essentially the form that is going to calculate and determine how much the Social Security taxes are, Schedule SE. It's not Schedule A because Schedule A reports itemized deductions. This accounts for medical expenses, state and local taxes, mortgage interest, charitable contributions. Schedule B, this is where we report ordinary dividends as well as interest. So Schedule B, whenever there's $1,500 or more for interest and dividends, Schedule B would be reported. Schedule F is for farming income and expenses. So A is our correct answer, Schedule SE. Here it says, what is the amount of the cost of goods sold for the current year? If a taxpayer has beginning inventory of $45,000, purchases of $175,000, and ending inventory of $25,000, what is the amount of the cost of goods sold for the current year? All right, so as it relates to determining the cost of goods sold, our calculation is as follows. So we start off with our beginning inventory, which in this case is 45,000. Then from there, we add our purchases. All right, and again, this is basically taking it back to accounting. This is how you, account for cost of goods sold. Same calculation as it applies to tax purposes. So we add our purchases, in this case, which is 175,000. We get this would be determined as total cost of goods sold. no, cost of goods available for sale. All right, so I'm giving the accounting terminology. We add this up. This gives us $220,000. So this is the total cost of goods that's available for sale. And now we use logic, right? So if we had a total of $220,000 of goods available for sale, and we only have $25,000 worth of goods left, the difference represents how much we sold, which is our cost of goods sold. So we had $220,000 worth of goods available for sale, but at the end of the year, we only have $25,000 left based on that logic. Oh, sorry about that. So based on that logic, that would mean that we sold $195,000 worth of inventory. So our correct answer would be B. So again, our total cost of goods available for sale. How do we determine that amount? We basically calculate how much inventory we started with. We add the total purchases, and that gives us the total cost of goods available to be sold. Then from there, we subtract, all right, how much worth of inventory do we have left? And that ultimately determines our cost of goods sold. This brings us to our next question. So it says her deduction will be: Heather drives her minivan 792 miles for business purposes in 2023. She elects to use the standard mileage rate for her auto expense. Her deduction will be. So we know that the standard mileage rate, and again, it changes each year, but for 2023, it is 65.5%. So how are we going to determine how much is going to be deducted for the standard mileage? So we can simply just copy over the information from this example. So the business miles, it lets us know here, is 792 miles. The standard mileage rate is 65.5 cents. So we get this subtotal. It doesn't mention anything about tolls and fees, 0. So our correct answer would be $519. All right, so the standard mileage, it makes things fairly easy. So this would be a subtotal. So our standard mileage cost would be $519. Again, 792 in business miles multiplied by the standard mileage rate. So I'll put times standard mileage rate, gives us the subtotal. And then from there, we add 100% of tolls and fees, if any. In this case, there were no tolls and fees. So therefore, the total standard mileage in this example is $519. In this example, it asks, how should he treat the expenses related to this trip? Joe is a self-employed information technology consultant from San Francisco. He takes a week-long trip to Chicago primarily for business. He takes 2 personal days to go to museums and see the sights of Chicago. How should he treat the expenses related to this trip? So travel expenses is mentioned, governed by Section 162. They are defined as ordinary and necessary expenses that's incurred in traveling away from home in pursuit of the taxpayer's trade or business. Again, what's the purpose of a trade or business, or the definition per tax law? It's any activity engaged in for profit. So in this case, we see he's a technology consultant. He went away for a business trip primarily. However, there was also some pleasure included. He went to the museum, and he also went to sightsee in Chicago. So whenever a taxpayer has a trip that includes both business and pleasure, they can deduct only the costs that are associated with the business portion. So you definitely want to keep that in mind. And there's one nuance. If it's within the United States, there's some different rules, some special rules and limitations that apply to travel that includes both business and pleasure when you travel outside of the US. So in such case, only the cost, or we'll go through all of the answers rather. So the cost of all the airfare and the business days should be deducted, while the cost of the personal days are not deductible. This appears to be true, but you always want to go through every answer choice. So it says half of the trip should be deducted as business expense since the IRS limits such business expenses to 50% of the actual cost. That's not true. C, 100% of the trip should be deducted as a business expense since the trip was primarily for business. Unfortunately, that is not true. Only the business portion can be deducted. D, none of the expenses are deductible since there was an element of personal enjoyment in the trip. No, A is our correct answer. So we can only deduct the portion that is business related. The personal expenses are not deductible. Next, we have meals and entertainment. Which of the following is not likely to be a deductible expense? So there was a very big change with the Tax Cuts and Jobs Act as of 2018 going forward. So as it relates to meals, some taxpayers, who operate their business, sometimes they're working late or they're meeting with clients and things of that nature. So in cases like that, they need to account for any expenses that they might have. Entertainment in particular, with the Tax Cuts and Jobs Act, any activity that's considered to be entertainment, recreation, amusement, they are not considered deductible pretty much. So there's no deduction for, as we just mentioned, anything related to entertainment, amusement, recreation. In the past, prior to the change to Tax Cuts and Job Act, they were deductible to an extent. Membership dues for any club organized for business, for recreation, or other social purposes, not deductible. Anytime a facility is used for any of the two aforementioned things, entertainment, amusement, membership, etc., is not deductible, unfortunately. Meals, however, in which business is conducted, and the taxpayer or maybe the taxpayer's employees are present. And one of the key things is it cannot be lavish and it cannot be extravagant. So in such case, it remains 50% deductible. There were some changes in 2021 and 2022 where it was like 100% that was allowed to be deducted, but it's reverted back. And there were also some rules, some caveats to claiming full 100%, but for the most part, meals are generally 50% deductible. So we'll go through these examples. Here it says, which of the following is not likely to be deductible? The cost of tickets to a stage play for a client and a taxpayer. This sounds like entertainment, but we'll go through all the answer choices. The cost for Rosa to take a potential customer to lunch to describe a new service Rosa's company is offering. Unfortunately, the customer explains that they are not interested in the service. So being able to deduct the expense is not contingent on closing a sale. Rosa took the client out to eat. It is considered a business expense. The cost of a party for all of Dan's employees to celebrate a record-breaking profits year. This is considered deductible. The dues for Charles Colt to join the City Chamber of Commerce to generally improve the reputation of his business in the community. So this membership due, it's not for pleasure, recreation. So what is not likely to be a deductible expense, and then, the dues to the City Chambers of Commerce can be considered ordinary, necessary, right? So the cost of the tickets to the stage play, this is not likely to be a deductible expense. Next, we move on to office and home, aka home office. So it's asking, how are the home office expenses treated on her current year tax return? Kathy is a self-employed taxpayer working exclusively from her home office. Before the home office deduction, Kathy has $3,000 of net income. Her allocable home office expenses are $5,000 in total, and it includes $2,000 of allocated interest and property taxes. How are the home office expenses treated on the current year tax return? So some taxpayers, they don't have a brick and mortar, right? They operate out of their home. The law provides certain circumstances under which the taxpayer can take a deduction. One key thing to keep in mind with the home office, however, is it cannot generate an overall business loss. With the exception of mortgage interest and property taxes, those are, tax deductible anyway, because you can also report it as itemized deductions on Schedule A. So just keep that in mind. So the general rule for home office states that taxpayers, they are not allowed to deduct the use of the home office unless there's specific rules. If they use the space on a regular basis and exclusively as a taxpayer's principal place of business, if it's used exclusively on a regular basis by patients, clients, customers for meetings, in the normal course of operations, if there's a separate structure not attached to the dwelling unit, or if it's basically again used on a regular basis in the taxpayer's trade or business. And lastly, the deduction is allowed if it's used on a regular basis for storage of business inventory or product samples held for use in a taxpayer's trade or business. But as mentioned, one of the key things, the home office deduction cannot reduce net income from the business below zero. So in this example, now again, we need to determine how much is going to be deductible. So she has $3,000 of net income. We know that that is essentially going to be one of the limitations. So A says only $3,000 of home office expenses may be deducted, resulting in net business income of zero. The extra $2,000 of home office expenses may be carried forward and deducted in a future year against home office income. So this seems correct, but we'll go through the other answer choices. B, all home office expenses may be deducted, resulting in a business loss of $2,000. That's correct. That is incorrect, sorry. Because again, home office expenses cannot generate a business loss. C, only $3,000 of home office expenses may be deducted, resulting in net business income of zero. None of the extra $2,000 of home office expenses may be carried forward or deducted. So the first sentence is correct, but the second sentence is incorrect because the extra $2,000, you don't lose it, it carries forward. And then D, none of the home office expenses may be deducted since Kathy's income is low. And that's incorrect. So the correct answer is A. She can claim $3,000 of home office expenses, and the $2,000 that was not used this year, it would carry forward to the future years. All right. So here is asking us to complete the table below to determine the net income Margaret should show on her Schedule C. It says Margaret started her own business in the current year and will report a profit for her first year. Her results of operations are as follows. So it wants us to determine what's our gross income, our expenses, travel, etc. So we'll take a screenshot of this. All right, so it's asking us to complete the table below. So it's fairly similar to the problem that we answered before where we completed the Schedule C. Gross income lets us know is $45,000. So we've accounted for the $45,000. There's travel of $1,000. Here it says a contribution to presidential election campaign. So anytime there's, certain political contributions, those are not considered deductible. So that is something very important to keep in mind. That is not considered deductible. So we can, account on, we don't need to account for that. Next, we have our transportation. So there's 5,302 miles. All right, perfect. So how do we determine that again? We know that it is the standard mileage rate, which is 65.5 cents multiplied by the business mile. So in this case, it lets us know 5,302 miles. So 5,302 multiplied by 0.655. Therefore, the deduction, we round it, would be $3,473. Entertainment, in total, $4,200. Unfortunately, as mentioned, with the change to the Tax Cuts and Jobs Act, even though she spent $4,200, $0 is considered deductible. All right, as it relates to the gifts that were issued. So with gifts, there's some specific rules that we need to, keep in mind, because if there were no rules, people would definitely more than likely take advantage of gifts. There are some limitations. Within limits, taxpayers are allowed to deduct gifts, but as mentioned, there are limitations. So as far as the gifts, it's essentially $25 per year per person. So just keep that in mind. And in the event that, let's say, a gift is given to both a husband and the wife, $25 is the limitation for both husband and wife, unless the spouse is also a client. So that's something important to keep in mind. So yes, we spent $450, but based on the IRS law, it's $25 per person. So 9 times 25. So therefore, gifts are only deductible at a cost of $225, $25 per person per year. And again, if it is a married couple, if only one person is a client, then if you give gifts to both of them, 25 applies to both. But if both the taxpayer and the spouse are clients, then it's $25 each per limit. So just keep that in mind. Next, we have rent and utilities. So we need to determine, it says rent and utilities for apartment in total, $10,500. 25% is used for a home office. So 10,500 multiplied by 25%. And we see there's in this case, there's no limitation, because we see that there's clearly a big net profit, 45,000, 1,000. And then that's why we see on Schedule C, rather, they have tentative profit. So we'll actually, do it the Schedule C way. 45,000 minus 1,000 minus 3,473 minus 225. This gives us our tentative profit. So therefore, there's no limitation for the home office expenses of $2,625, because it is not going to cause us to have a loss. So we claim the full amount. So we add up our total expenses. And this one is not deductible. Entertainment is not deductible. And then for these, there's a portion. So because there are limitations, I put those in orange. So the yellow were 100% deductible. The transportation was 5,302 multiplied by the standard mileage rate, which is 65.5. Entertainment, due to the Tax Cuts and Jobs Act, is not considered deductible. There were 9 gifts at $50, but the IRS rule is $25 per donee per year. And rent and utilities was $10,500 in total. But the business portion, home office, is 25%. So 10,500 multiplied by 25% gave us this 2,625. So now the next step wants us to determine our total expenses. So we have 1,000 for travel, 3,473 for transportation, 225 for gifts, and 2,000 $2,625 for rent and utility. That gives us total expenses of $7,323. So to determine our taxable income, we subtract our total expenses from our gross income. And that gives us taxable income of $37,677. All right, this brings us to our next problem. It asks us, how much is Marty's deduction for meals and entertainment for the current year? Indicate whether the following are deductible, partially or fully, or not deductible. So it states, Marty is a sales consultant. Marty incurs the following expenses related to the entertainment of his clients in the current year. So we have dues to a country club. The country club was used for business. 25 days of the total 75 days that it was used. Business meals at the country club restaurant not associated with golf or tennis. Dues to a tennis club. The club was used 75% for directly related business. Tennis fees for personal use. And business meals at various restaurants. So as mentioned, the Tax Cuts and Jobs Act, there are changes in the tax treatment for any activity that's generally considered to be entertainment, amusement, or recreation, in addition to any membership dues for clubs organized for business pleasure, recreation, social purposes, in addition to, utilizing a facility for those reasons. So in such case, we need to determine what is going to be taxable. So how would we determine? So we see here, dues to a country club. The country club was used for business, 25% of the 75 days that it was used. So unfortunately, the dues to the country club are not considered deductible. Likewise, the dues to a tennis club are not deductible. So there's $4,500. I'm actually going to we'll put it side by side so we can X out what is not deductible. So the 4,500 is mentioned. It's not considered deductible. The dues are not deductible. The same thing, the dues to the tennis club are not considered deductible. Next, we have, well, we know for sure the tennis fees for personal use. These are not deductible. But what is still left? I'll just X these out so it kind of makes it a little clear. What is still left is the business meals at the country club restaurant, not associated with golf or tennis, and the business meals at various restaurants. So this 1,400 and this 1,900, they are both subjected to the 50% limitation. So 1,400 plus 1,900 gives us a total of 3,300. We multiply by 50%. The total amount that Marty is allowed to deduct for meals and entertainment is $1,650. So again, the dues to the country club and the dues to the tennis club are not deductible. The tennis fees for personal use are not deductible. However, what is deductible, subject to the 50% limitation, are the business meals at the country club and the business meals at various clubs. We added the two. 1,400 plus 1,900, and we multiply by 50% for a total of $1,650 for meals deductions. So then it says, indicate whether the following are deductible, partially or not deductible. So dues to the country club, as we mentioned, are not deductible. Business meals at the country club are deductible. Dues to the tennis club, not deductible. Tennis fees for personal use, not deductible. And business meals at various restaurants are considered deductible. So this brings us to our next question, looking at home office expenses. And it's asking us to determine the deduction for home office expenses depending on the, income, the net income, because obviously there's a limitation. So it states, Cindy operates a computerized engineering drawing business from her home. Cindy maintains a home office and properly allocates the following expenses to her office. There's depreciation, utilities, real estate taxes, and mortgage interest, 100% deductible. So as we know, some taxpayers, they operate their trade or business and they qualify for this home office deduction, but there are some strict limitations. Obviously, it's only the business percentage and it's based on, the square footage. So let's say, the square footage of my home is 100 square feet and I use 10% of my home. In such case, I can only deduct 10% of all of the expenses. So just keep that in mind. So here we see in this example, we will calculate the total. So 1,500 for depreciation, 500 for utilities, 325 for real estate taxes, and $500 for mortgage interest. So in the first scenario, to calculate Cindy's deduction for home office expenses, she gets to claim the full amount, right? Because it says that it properly allocated. So there's no extra calculation we need to do. The calculation was already done. So because Cindy already earned, or her net profit rather is $4,400, there's no limitation. We claim the full $2,825. And we know that one of the key things with the home office is that it cannot reduce the net income for the business below zero. So therefore, in this case, because the net income is $2,600, Sydney can only claim $2,600. The additional $225 that she was not able to claim this year, does she lose it? Absolutely not. The $225 of home office expenses that Sydney was not able to use this year, it carry forwards to the future years where there is home office income. So we have another problem with the home office. Because sometimes the home office, as I mentioned earlier, 10% is used for the home office. The total square footage of the home is 100. So 10% is deductible. There are also some examples where you can use the simplified method of the home office. So kind of think of it like the standard mileage rate, where you just, get a rate, or your total business mileage rather, and you simply just multiply it by the standard mileage rate versus the actual cost where you need to keep receipts and all of these different things. Same thing here. For the home office deduction, you need to be able to calculate the total for utilities, repairs, and things of that nature. But there's also a simplified method. So here it is asking us to calculate the largest deduction Randy can take for her home office. Randy qualifies for a home deduction. The amount of space devoted to business use is 400 square feet of the total 2,000 square feet of her home. Randy's mortgage interest and property taxes in total are $1,600. Other deductions properly allocated to the home office total $300. In addition, Randy purchases and uses business supplies costing $200 during the year. Assume Randy earns income of $3,400 for the year before deducting any home office or supplies deduction. All right, so how do we answer this question? Let's look at our gross income for the year. So one key thing to keep in mind, right? And sometimes they throw information into the question that doesn't really impact what we're trying to do. So it says that she used business supplies costing $200. This has nothing to do with home office expenses. So in order to determine our home office deduction limit, $3,400 minus $200, because that supplies expense will be a part of our tentative profit and loss. So keep in mind, as we saw the Schedule C in the first problem, we have a tentative profit or loss, and then we account for home office expenses, supplies, would be considered a regular expense, not, a part of home office. So $3,200 would represent our home office limit. So we need to determine what is our, actual home office deductions. So in this case, it's 400, which represents the portion of the, home office that's being used, but the total house is 2,000. So therefore, Randy can deduct 20% of the expenses. So in this case, mortgage and interest and property taxes are 1,600. And then other deductions allocated to the home office in total of 300. So sometimes there's some direct expenses. So let's say, you paint over your home office. There's no allocation because 100% of the fees paid to paint the room are pertaining to the home office itself. So our calculation would be as follows: 1,600, which lets us know is Randy's mortgage, interest, and property taxes. We multiply it by 20%. And that gives us $320. And then we account for the other deductions that are 100% allocated to the home office. So 320 plus 300, our overall home office limit deduction is $620, right? So that would be an example. And now, in an effort is mentioned to kind of make things a little easier to, reduce the complexity of this home office deduction, the IRS utilizes this simplified method. So under what's called the safe harbor, the taxpayer, they're allowed to deduct home office expenses of an applicable rate. And in 2023, it's $5 per square foot. But the maximum is 300. So simply stated, the maximum square footage is 300. And if it's $5 per square foot, then the maximum amount would be 1,500. So in the event that the safe harbor method were to be utilized, let me understand this question properly. Sorry, I'm looking at the question wrong. So 620 would essentially be the home office expense, but it's asking us for the overall home office deduction limitation. So as we calculated previously, the 3,400, which represents the income earned minus the $200, that's considered a regular expense, for lack of a better word. So it would not be considered in a home office. So the overall home office deduction would be $3,200. We just calculated that the home office is 620. So therefore, Randy would be able to claim the full 620 because there's no limitation. Now, if we were to utilize the simplified method, it'll be 300 square feet, which is the maximum, multiplied by $5 per square feet. And under the simplified method, it would be $1,500. All right. So just keep in mind that, the $1,500 obviously is less than the deduction limitation. So just keep that in mind. And, even if the simplified method is used, the deduction is still limited to gross income. So you definitely want to keep that in mind. All right. And again, this is the home office deduction under the simplified method. But again, it's obviously dependent on, how much was used. Here it says that she uses 400 square feet, but the maximum per the rules is $300. So that's why 300 square feet rather. So that's why we use 300 square feet versus 400, because 300 square feet is the maximum. So 300 times 5 gave us this 1,500. 3,400, which shows us her profit, but then they threw in a little trick. This $200 does not impact the home office expense. It is an ordinary expense. So that is how we calculated the overall home office deduction limit. This next problem asks, select yes or no to indicate which of the following are factors the IRS will consider when evaluating whether the activity is a business or a hobby. Lou is a practicing CPA who decides to raise a bonsai as a business. Lou engages in the activity and he has the following revenue and expenses: sales, depreciation on the greenhouse, and advertising. So it wants us to know which factors will the IRS consider to determine if it's a business or a hobby? If it is if the business is being carried on as an activity in a business-like manner, yes, that has an impact. The time and effort put into the activity indicate you intend to make it profitable, yes. Dependence on the income for the taxpayer's livelihood, obviously, yes. Whether the losses are due to circumstances beyond control or are normal in the startup phase in this type of business, yes. Attempts to change methods of operation to improve profitability, yes. The taxpayer or advisors have the knowledge needed to carry on the activity as a successful business, yes. Success in making profit in similar activities in the past, yes. The activity makes profit in some years, yes. The activity is expected to make a future profit from the appreciation of activities using the asset. This is yes. So in this example, if the activity is deemed to be a regular business, what is the amount of loss from the activity? So we get our handy dandy calculator. Sales were 5,000. We have depreciation expense of 10,000 and an advertising expense of 1,500. So therefore, the total loss, if it's deemed to be a business, is 6,500. If the activity is deemed to be a hobby, none of the expenses or it's limited rather. So the expenses will be allowed to be deductible, but they are limited to the extent of income from the activity. So in such case, the expenses, if this were a hobby, would be limited to $5,000. So it cannot exceed the income. So that's one of the key differences between if it's being treated as a business or if it's being treated as a hobby. Hobbies cannot generate a loss for tax purpose, but businesses can. Next, we see once the taxpayer uses the standard mileage method to determine the deduction for automobile expenses for the tax year, the standard mileage method must be used in all subsequent years. This is false. So if the taxpayer uses the standard mileage method in the first year, the taxpayer can use the standard mileage method or the actual cost method in future years, basically whichever gives the taxpayer the largest deduction, as long as the taxpayer maintains adequate records of the actual costs when they use that method. Here it states for the current year, what is the amount of Bob's business gift deduction? During the current year holiday season, Bob, a barber, gave business gifts to 34 customers. The value of the gifts, which were not of a promotional nature, were as follows. So we know that the limit is $25. So we need to be, here we see $10. Obviously, it's not going to be 10 at 25. Why? Because we only paid 10, but the maximum is 25. So 10 times 10 gives us $100. And then from there, we need to account for these 8, 16, 24 gifts that were made. So for 8 gifts, we paid $25. Another 8 gifts, we paid $50, and another 8, $100. Doesn't matter. The IRS limitations are the IRS's limitations. So therefore, 100 plus 24 times 25. Oh, no. PEMDAS messed that up. So 24 times 25 is 600 plus the 10 gifts at $10 for a total cost of $700. So again, the 10 gifts at $10, we multiply that and it gives us 100. And then for these 8 plus 8 plus 8 for a total of 24, even though for 8 of the gifts, they pay 25, 50, and 100, it doesn't matter. The IRS limits gifts per year per donee to 25. So I'll do the calculation again. 24 gifts times the $25 limit per gift gives us a total of 600, plus the 10 gifts at $10 each. So 10 times 10 gives us 100. So 600 plus 100 gives us a total of 700. And this question is related to the hobby loss. So in determining whether an activity should be classified as a hobby, the tax law provides a rebuttal presumption with regard to the profits or losses of an activity. Which of the following statements describes the profit/loss test that must be satisfied in order to meet the presumption that the activity was engaged in for profit as opposed to just being considered a hobby? So one of the rules for this is that, there must be a gain or profit rather for the past 3 out of 5 years. Because again, if you just keep having a loss, the IRS might look at it as, are they really trying to run a business? Because there are some people who unfortunately take advantage of having a loss, because especially, high income payers, or it doesn't even matter, just a business loss overall is an ordinary loss. So it will essentially reduce your taxable income, and the IRS does not want anyone taking advantage of the tax law. So one of the rules is that the activity shows a profit for 3 of the 5 previous years. And when it doesn't, then Uncle Sam might start to probe to consider, or confirm rather, if it is a hobby or if it is a business. And, the IRS basically, or the taxpayer rather, basically has to prove such. So here it's asking us to calculate Jones' travel expense deduction for the trip, assuming the trip was made in 2023. States Joan is a self-employed attorney in New York City. Joan took a trip to San Diego, California, primarily for business, to consult with a client and take a short vacation. On the trip, Joan incurred the following expenses. So, as we know, travel expenses, they're defined as ordinary and necessary expenses incurred in traveling away from home in pursuit of the taxpayer's trade or business. So the expenses are deductible as long as they can be substantiated. Do you have proof? Do you have receipts? In addition, they should not be lavish. They should not be extravagant. So whenever a taxpayer makes a trip, and there's a component of it that is business related and a component that is personal, there are specific rules when, this trip takes place within the United States, and there's a specific set of rules when it happens outside of the US. So essentially, any personal expenses, unfortunately, are not considered deductible. So our calculation would be as follows. Airfare to and from San Diego, in this case, $975, that is considered deductible. Next, we have our hotel charges while on business, $375, that is considered deductible. Next, we have restaurant meals while on business. So we know that, meals are considered 50% deductible. So that's something for us to keep in mind. So we can see clearly here, hotel charges while on vacation, restaurant meals while on vacation, car rental while on vacation. These, last 3 expenses are not considered deductible. These are related to vacation. So we'll do the meals first. We'll, start back the calculation, 270 multiplied by 50%. So for our meals, only $135 are considered deductible. The car rental while on business of $90, hotel charges while on business of $375, and the airfare of $975. So that gives us a total of $1,575 that is deductible. All right, this brings us to our last problem, dealing with inventory. And we know that part 3 of the Schedule C deals with cost of goods sold. So it says use part 3 of Schedule C from Appendix F to calculate Tori's cost of goods sold for the year. Tori owns a retail store and during the current year purchased $754,000 worth of inventory. Tori's beginning inventory was $75,400 and ending inventory is $90,480. During the year, Tori withdrew $15,080 in inventory for personal use. Assume that he uses the cost method to value the inventory and there was no change in determining quantities, costs, or valuations between opening and closing inventory. So we are completing Part 3. So the method used to value closing inventory can be cost, lower of cost to market, or attach explanation. It lets us know here that it uses the cost method. It's asking, were there any changes in determining quantities, costs, or valuation between closing and open inventory? The answer is no. The inventory at the beginning of the year was 75,400. Purchases less cost of items withdrawn for personal use. So we see here that it lets us know 754,800 was purchased. However, a portion of it was used for personal use. So 754,000 was purchased. We subtract the amount used for personal use, 15,080. So 738,920. Then from there, we add lines 35 through 39. So we have the net between the inventory purchase, 754,000, minus the 15,080 in inventory for personal use. And we add our beginning inventory of 75,400. This gives us total cost of goods sold of 814,320. Now, the next step is to account for the inventory that is left, 90,480. So again, think of it like money. You started off the year with $814,320 in your bank account. And now at the end of the year, you only have 90,480 left. So the difference represents how much you spent. So in this case, the difference represents the cost of the goods that we've sold. We had 814,320 cost of goods available to be sold. At the end of the year, we only have 90,480 left, which lets us know that we sold 723,840 worth of units. All right. So this brings us to the end of the questions for Chapter 3. And again, this chapter covers Schedule C, which is the profit or loss for businesses. And we also discussed many of the common expenses that businesses are allowed for deduction purposes to determine their taxable income or net loss.